What's up, peeps? So this is the analysis for R.A. Williams. It took me a little bit longer to go through some stuff, seeing that I said I needed to familiarize myself with the industry because I honestly don't know much about it. But at the end of the day, I just chose a number. So if any of this interests you, we're going to, you can see, we're going to market share, the financials, the metrics, the debts that they're going to pay, and who they owe, relative valuation, and I guess some fun facts about like this type of company. So yeah, but that's it. Don't forget to like, share, comment, subscribe to our friend, and let's begin. All right, so the first thing we're going to look at is their 5 year. And to be honest, like some of the stuff was missing. At least that I needed to do what I wanted to do. So I only could have done like a few stuff with this. However, I can tell you that year over year, as you can see, they have been incrementally growing. They boomed in 2023, which is crazy. However, the CAGR, which is mean like them component annual growth rate, mean like what is their growth rate is 27.25% as it relates to their revenue. Sales, as in like net sales now is trickling behind, but it's still good. Still good. Means say they are for the most part maintaining the expenses, the expense level. So 21.98. Right? Say see now in the 5 year, we can show you the 5 year DuPont because that's the only thing that I could have done. Say just close this up a little bit. And the main driver, as you can see, was initial leverage, which is debt. Um, yeah, debt was the main driver for a good while, especially in 2022. But then it started drop off, meaning that they have been paying off their debt. I think if they do get the subscription that they need, it's going to drop significantly because the debt going to be above 56%. That's so sure. Say so leverage is what been their job. Means them just borrow money and make money on it. No, seeing that they have been borrowing, what eventually starts showing now is that they have enough assets and they're starting to make better returns, as you can see. Um, Trickling up. The profit margin and return on equity has been relatively stable. It's about the same. And if you look at the actual figures, you can see for the most part, say they have been like relatively flat in a way. Say, if you can see profit margin, zoom up for some persons who are look on them phone, say 8.65%, 3.54, 6.44, 5.27, and 7%, which is the latest, which is 2023. And I stopped doing quarters. I just prefer the whole year thing. Um, yeah, if it's like this is just the IPO, so we're going to have to see what happens at the end of that. Anyway, so yeah, that is their DuPont. Fun fact: the return on equity is high, like it's good, but it's, like return on equity is really about what internal company like us as shareholders. Yes, on paper it's good, and you can project the growth of the equity or the growth of the company. However, you don't really see that as the average investor. It's good on paper, so the company doing well, but we really benefit like when stock price appreciate. And honestly, in Jamaica market, the stock price appreciate when it comes to vibes and dividends. So yeah. However, the industry, the industry return on equity is 11.84%, and they are at 32. When we go for relative valuation, you'll see that part. All right, now. So as I say, there was some figures missing for the 5 years, and whenever I go on a wild goose chase, so I just did it for the 2 year, which would have be the 2022 one, the 2020 three. With this, essentially the same thing up here. So there wasn't anything major to point out, but other than I guess you can probably look at their total liability. This going pop up back a little later, but really with the 2 year, I could have done the almond T score. And normally, we want a company that is over 3 for almond T score, especially a big company, and especially manufacturing. It's predominantly for manufacturing, but retail is the next thing for manufacturing. So you manufacture, then you retail, or distribute, and then yeah. So last year them been kind of sticky, but this year them pick up, which is good. And I want to see what they're going to do next year. All right. So next thing is cash flow conversion. Cash flow conversion or cash conversion cycle mean when them get it, to when them sell it, to when them collect them money um for it. So them get it to when them sell it and which part them pay it. It depends because as a distribution company, oftentimes manufacturer will just send it for a period and then you get them back. All now they can like understand this a little bit more extensive. You can see the calculations. So days inventory outstanding mean, as I say, average inventory cost of goods sold. So how long you take to sell it, or distribute it, and then sales, which is receivables, how long you take to get back your money, and then payables, how long you pay the people them, like how long you take for pay the people them. So yeah, all this number when you calculate it really just trickles down to how long the cycle takes. So from the moment you get the products to the moment you sell it and pay back the suppliers. And this is roughly 65 days. Or at least how that cycle here go between you and the retailers that you're selling it to. So it's really for you and the retailers. And 65 days, which is 2 months roughly. But in 2023, them drop it down to 46 days, like a month and a half, which is good. They're collecting their money faster now from their person, like the person with them supply. So this was the other part, which I found it interesting because, as I say, they break down like the volumes at sale. So like the person them who buy and at what level. So as you can see, there is some feel upon each year you're seeing the under 500,000 decline marginally, which means they're going into like everybody declining. This is good unless this is good if we reach down to like the higher parts, they're growing, and as you can see it growing because from 1 mil 2 mil now you see start gradually grow. So 16 18 15 9 11 13 6 8 7 2 4 1 means your more customers are building relationship with them, and essentially they're buying larger volumes or spending more money with them, which is good. And what also happens is that their customer base has been growing. So you can see it has shown them customer base, and it also shows yes, their customer like they've been getting bigger volumes. So people that usually spend a little bit of money start spend more. So there is that. The next one is basically cash flow conversion, but then break it down better to show like when them supposed to receive the money. You see me? So one day, one like 1 to 30 day past due, as you can see, it grow. So most persons are pay after the 30 day mark. 30 60 days has fallen, which as me I say, it start is like basically I say essentially the sweet spot for when them collecting by the money is about the 2 month mark, which is what this did basically I say. So yeah. And then you have some unicorns past due 0.8, and then yeah. Well, I guess maybe they have different contracts and different things for each person per se. So I think the only thing left up on the sheet here is the ratios. As I say, I was going to play Goose Chase for them 5 years. So You can stop and look at the ratios. Not much per state. It seems similar to the industry. Current ratio is good. You want something at least 1 to 1. The thing with quick ratio for this now, remember there that the inventory that they have, is already finished pharmaceuticals. Which I feel like even if in a situation that you're doing a fire sale, you're going to still be able to sell off your pharmaceuticals real fast. So I get current ratio and I get quick ratio, but I wouldn't too lean much on quick ratio because I just feel like you can sell off pharmaceuticals fast. So yeah. Inventory turnover, while it low, and the truth is, a lot of persons, I'm just admitting now because my probably forget. A lot of persons they really spend money on like when them sick and man, like meals in like it's like probably a third of the population. Like literally, is them organs of here drop out. You see me before them decide say them all go doctor. So I understand. I understand that much. Average collection period, same for the most part. And how long it tie up basically the cycle. So then basically I say call every half year or a little bit over half year, them sell their products and have to replenish from the um supplier that they have. Gross sales been the same, um, which means I guess the cost of goods are roughly the same. However, the marginal increase means that them probably just be a bit more efficient with them expenses, and then debt equity ratio want at least 1.5 or 1, and them cross to that, and then interest coverage means say based on what them have right now, how much time, based on their revenue, how much time we can net revenue, how much time we can cover them interest. And 2022 them could have covered 3.73 time, 2024 them can cover it a good more. And I'm assuming say by the IPO close, it's supposed to can cover this way more. So next thing is market share. So the market share essentially just shows like a visual representation of how big the company really is compared to the industry, the distributor and sector. And yeah, while this is not 1 to 1, it is within the industry or the junior market. So there is that. Yeah. So R.A. Williams, which is this one right here, so really is just 2% of this, as you can see. R.A. Williams would be 2% of the market. Like that's the volume that they hold, 2% as it stands. And these are not even all of the competitors. You have Demir, plus you have Lasco, and maybe Fantan. You can probably take out Fast Rich, but then you're gonna have to put in the other competitors, which are, well, as them did say stated, them have Carimed, Facey, Indies, Lasco Distributors, massive, Mediplex, medical disposable, and supply. And one thing that is constant with all of them, so while they might say, oh, the market, but what is common in all of them is that them all have local means say, oh, they basically are fight for the same market share like what the rest of them have. In addition to the fact that some of them have other places overseas. So yeah. And you go for see, Lasco is killing it because Lasco make 20 something bill the this year. So, they have enough room for growth. We're going to have to see if they're going to start taking over the market share. But for now, them just go on clutch right now. Granted, they have been growing little guys based on which one them they. You can see that the market share has been growing. If you zoom up, look a bit. So it was at 1.57%, 1.72, that's it. Look a while later, graduate look a thing. We're going to see the next trajectory. So there is that. Metrics now. We love the dividends. And to be honest, from I read this snippet, but no zero is not a company that go pay a dividend. Honestly, them not really pay much dividend. Just keep that stock. It say the company analyze the importance of dividend as a means to return value to shareholders, but emphasizes responsible financial management. If the company ordinary shares are admitted to the general market, the director intends to pursue, means they're not even go there, enough to pursue a dividend policy that projects an annual dividend of 25% of the net profit available for distribution, subjected to reinvestment from the board, etc., etc., and from time to time, blah blah blah. Basically, I'm gonna say, yo, well, we don't say, yo, we don't like dividend, but we're gonna keep the cash. That's why I say, what a company really good on paper, but as investors, we're not really gonna see it unless the stock price move. So, yeah, so much it. So we just pull back the 5 year financials and then just do 25% of net revenue. But that multiply by 1,000 because they did average it. So then we take off the zero zeros, and this is just a rough thing. As you can see, zoom up. As you can see, it's been growing like on the assumption that they were paying dividend in the past. It's been growing, and long and short really is like if the stock price is $1 and it stays at $1, probably you're looking at probably like maybe 0.1% dividend for you at the end. So yeah, see I get 0.0123 if they pay dividend this year, and yeah, don't look for this as a dividend company. That's all I can say. And also the company is just they're selling 20%, because when you look back at the the list of who owns what, essentially when you look down back to these last four things, says company, applicants, key strategic partner, and general public, it 10.5. So 10.5 to the general public, and then company and applicants 1.5, and then 8 for key strategic partners. Means say at 20% effectively them release. Say, and while we're at the metrics of what them release, might always go to the debt. Like them have this thing on their thing. I just put it in Excel basically, and essentially it just shows them debt and look who them owe. Them owe Sagicor true and true. Them owe Sagicor right through. Them owe Sagicor right through. Like them buy highest bus, Hyundai bus, RAV4. Some of them here is like big vehicles, and then all of them are like trucks. So I guess it helps for distribution. And then furnitures and fixtures and the benches with them 2023 I assume so that pay off. So that's why I never add it in there, because I end up minus it out. Yeah, I end up minus it out of the calculation. As you can see, E8 and E9. So minus total calculation. So about $208 million them out to Sagicor right now. Of which, if them pay off Sagicor $208 million, um, them still have some change left. And the use of proceeds just for like yeah, visual representation or whatever I use it though. 76% I going to use to pay off debt, like legit. 49% JC fees are more spending than what I'm actually are gonna use as capital, and it's just to buy a solar thing. So I guess we just probably save energy. So they use that. When them pay off, so based on the amount of money that them supposed to get if them subscribe, if them get them full subscription, based on the amount of money that them get, compared to their liabilities, them total liabilities down here, so which may I say will I come back to. Yeah, compared to that, it'll be about 56% of their liabilities them up you have. So Yeah, which should help their metrics look better. As I say, it just a go look good on paper. Not really see the value like that. But yeah, so that's their debt in a nutshell. Yeah, so yeah, that's their debt in a nutshell. The next thing now is before we go to the evaluation, some fun facts, I guess. So apparently, the thing that is killing off most of Jamaican based on our sex is strokes. So strokes, so that's the medication that them do. Strokes, diabetes, heart disease, prostate cancer, which is in men. My God, kidney disease, hypertension, prostate. Man, them do one them bottom. But yeah, so men just go get and check. I see there we're one of the leading cause the top four. Is me. So there is that, and then this is basically just a show where the money I go. Yeah, the based on which one the money I go. So yeah, brother. And apparently is like in 2020 was 6.6% of the GDP used out of pocket from the government. Anyways, that's just some information. Relative valuation now is pretty simple. As I say, I look on it, it going to still be in the retail. As you know, it going to still be in the retail industry. So yeah, you can see the PE is about average, especially if you're just isolating and looking at the companies that is directly in their industry. So you have this, you have Indies, medical. So them here and I I gonna say they're in the junior market. In the junior market, they mean so I have to put them in the junior market. Let's go that in the other one. So yeah, so it at the highest. It's the highest when it comes to like them direct them need even higher than the industry average. So there is that. The book value per share is smaller than the industry average, and the price to book value is higher than it. So it is walking red flag. Anyways, walking red flag. Anyways, the industry average is about 75 cents. That's where um it there right now based on industry. And I always say relative valuation is just relative compared to the industry that it's in. See me, if you're putting a vacuum with all the other companies, it might be different. But yeah. So yeah. Um that is it. Hope you guys I don't know what to say about it. Honestly, I feel like I'm going to start a Patreon. Yeah, and we can have like some serious conversations about some of these stuff. I don't want to say anything. You mean like wait, through thoughts, inner thoughts. So, yeah, so that is it for this video, guys. Hope you're there to the end. Hope you enjoy. As always, don't forget to like, share, comment, subscribe to a friend. This took me a minute to put together, so we're gonna just like the video. See me. Yeah. As always, love you guys and catch you in the next video. Peace.